that, well, the whole life has cash value, wouldn't the cash value give a very good return? Because if I don't need the coverage, I can surrender the whole life plan to get a return. Hi, welcome to Haven. In today's episode, we'll discuss the question, is life insurance a smart investment move? To begin with, there are two kinds of life insurance. One, insurance that provides protection as well as cash value, or the second type, insurance that just provide the pure protection only plans. For protection with cash value, these are policies such as whole life plans, ILPs, and even universal life. These are considered permanent insurance because it provides lifelong cover. On the other hand, pure protection plans are term policies with limited duration coverage. Example, covering for 5 years, 10 years, 25 years, or even as long as age 99. In terms of premiums, cash value policies are expensive. And that's because a bulk of the insurance premiums goes into funding the investments to get the cash value. Whereas for term policies, that is very affordable because you're just paying for the protection. So the question is this: by paying the extra premiums to get a cash value, is life insurance a smart investment move? Is the cash value able to get a good return on your investments? To answer these questions, you need to understand three fundamental principles which I'll go through with you. Firstly, the primary role of insurance is for protection, and it's not for investments. And in fact, the word insure, by definition, means to protect against a loss of something. What is that loss? A loss such as death, critical illness, or disability. When this happens, it results in a financial loss to the person. And no financial instrument can do better than insurance products in terms of paying a huge lump sum in the event of a trigger event. But how about investments? Is life insurance, the cash value kind, able to give a good form of returns? When you talk about investments, there are actually a lot of investment instruments out there for one to consider. It could be in shares, or it could be ETFs for diversification at low cost, or it could be bonds for conservative investors, and even investment robos that can be easily accessed at low cost. However, if you use insurance policies to get the investment returns, you realize that it involves usually high costs and charges. There's lock-in periods, there's surrender charges if one surrendered early, there is less flexibility in customizing the investments solutions, there are limited funds available. So in terms of investments, there is restriction when it comes to using insurance policies for investing. And thirdly, by unbundling the protection and the investment element, you could generally get a better results. There are a lot of studies or research that suggests, that confirms, or that push forth the proposition that buying term and investor shares will give a better returns for the investor. So the primary role of insurance is mainly for protection. It's not to generate the investment return. The second principle is this, is to ask ourselves, how long do you need a coverage? Do we need a coverage for a lifetime? In that case, probably a whole life is necessary, or it's just for a limited period whereby a term plan will suffice. And for most of us, protecting over the working years is the most important. To understand this concept, I'll present three scenarios that is applicable for most people. Firstly, the most important concern for working people is this, that in the event of a death, a critical illness, or disability, this person will not be able to work and therefore unable to accumulate the savings to provide for their family and for themselves. And the most important period for this need is actually the working years. Think about it. If you are retired, you will not need this coverage, this need, because firstly, there's no income to replace, you have stopped work. And secondly, you have accumulated enough retirement assets to provide against the issues of the risk of death, critical illness, and disability. So the need for this is actually a temporary need. And the suitable insurance for this will be a term policies, affordable term policies for most working people. The second scenario is a supplementary need. It's for people who want something extra to provide for alternative medicine that is not covered by their integrated shield plan, which is a hospitalization plan. For some of these people, they may want to have extra coverage to provide for alternative medicine like TCM, traditional Chinese medicine, a supplement, or a concern that some of the cancer treatments may no longer be covered under the integrated shield plan. So for this, the need will go for life, and therefore it's a permanent need, and the solutions will be like using whole life or term to 99. The thing to know about this need is that it don't have to be a very huge coverage. An amount of about 200,000 or 300,000 depending on your affordability would suffice. The third scenario is to provide a legacy. It is mainly for the affluent and the high net worth individuals. For individuals like this, the concern for replacing of loss of income is not a huge concern, but the concern is to provide a lump sum to their beneficiaries, to their family, even to give to charity should death occurs. For this, it's not time bound, it's not restricted to a certain period in time. As long as death occurs in the lifetime, it must be able to provide that payout. For this, again, it is a permanent need, and therefore, a permanent insurance like whole life, universal life, or term to 99 could be suitable for this need. So the second principle is to understand how long do you need a coverage. It's not a question about how well the return of the cash value policy will give to you, but how long do you need it to determine whether it's whole life policies, a permanent insurance is suitable for you. The third principle to understand is what kind of insurance product is suitable for you. To answer these questions, I'll illustrate with an example of using Mr. Tan. He's 40 years old, earning 100,000 income, wanting to look into protections for death, critical illness, and disability. Just to simplify this case, let's just use rule of thumb that for death cover, we assume 10 times of income protection for death and critical illness 4 times. That means that Mr. Tan would need 1 million death and TPD cover, as well as 400,000 of critical illness cover. He's presented with 2 options. Option number 1 is basically a term plan to age 65 because that is his working years. All right. The premiums that to support this coverage would be about $1,800 or $1,783 in this illustration. It's about $150 a month. Very affordable. For the whole life options, I'm using a whole life hybrid, which is actually a lower cost version of a whole life plan. For this coverage that covers lifetime, okay, the premiums will be $13,000 per year for the next 25 years of payment to support this whole life plan. So how will Mr. Tan choose? If he choose option 1, it will cost less than 2% of his income for this need. But if he choose option 2, because of the cash value, all right, he will need to incur about 13% of his income, not considering his other insurance needs like hospitalization, long-term care, even insurance plans that he needs to pay for the family. So the term plan is a very affordable solution to meet the most critical need for Mr. Tan. Another thing to note is that the difference in price between the term and the whole life is $11,240 a year for the next 25 years. Well, you may say that, well, the whole life has cash value. Wouldn't the cash value give a very good return? Because if I don't need the coverage, I can surrender the whole life plan to get a return. Let's dive in further. For the whole life plan, there are projections for the cash value. And insurance policies, there are 2 projections usually illustrated. One, 3% lower range, and the higher range is 4.25% projections under current climate. All right, I'm using the higher projections for this illustration. Suppose Mr. Tan would buy this option 2 plan. At 65 years old, if he were to surrender this plan, he, according to projection, okay, these are not guaranteed, according to the projection, he may get back about $306,000. If we continue to hold it until 85, he can liquidate and get about $787,000 based on projections. However, if Mr. Tan were to choose option 1, he would have saved $11,000 a year for next 25 years. Suppose he invests this money at 4%, similar to the returns in the insurance policies, but slightly lower, okay. This amount of money at 4% at 65 will give $486,000 based on projections, and this is higher than the whole life plan. And progressively at 85, at 4%, you get about $1 million, and again, higher than the whole life plans. So what this is saying is that by investing the rest, you can derive a better returns than putting money in the whole life policies. So there you have it. We have come to the end of this. To answer these questions, I presented with you 3 fundamental principles for you to consider to answer these questions. And let me wrap it up by saying this. Firstly, the primary role of insurance is for protection. It's not really for investments. It can provide the investment value, but it is not the best ideal to use insurance for investments. Insurance is best used for protection because there's no other instrument that can do a better job than using insurance for protections. We also learned that term policy is most suitable for people because firstly it's affordable and secondly it's effective to cover the most important period, which is the income working period or the working years. And lastly, there's still a role for whole life plan, but it's not because of the superior returns of the cash value, but because you need it for reasons such as to provide for alternative medicine or for legacy giving. So, I come to the end. At Haven, we are insurance specialists. If you have any comments or questions regarding this episode, or if you want to seek insurance advice, please write in to us at contact@haven.com. Thank you.